Good evening, class, and welcome to our taxation class. The last week, Tuesday by this time, we started the discussion on capital allowances, and we spoke at length about capital allowance, although on Friday, is it Friday? Yes, on Friday, I gave the solution to the basis period assignment that we had last time. So I want to assume here that all of us are experts on dealing with basis period. We must have studied the solution I gave, not really to look at the figures, but to study how the basis period is being built and developed. So that's the basis for that assignment. So just look at the basis period and just know that. Even though you don't know or you cannot fathom the figures, just know the basis period. Last week, we talked about the capital allowance. So I want to share my note now so that we can continue our discussion on capital allowances. So we talked about some of the things we talked about in capital allowances are, okay, let me skip the class rules because I want to assume all of us know the class rule by heart by now. So some of the things we discussed about capital allowances include what capital allowances are, the conditions for granting capital allowances. We said that capital allowances are granted on qualifying capital expenditure, and that the asset that qualifies for that should remain your property or the property of the business at the end of the basis period, and it must be used for the purpose of business. We also saw two exceptional cases, that is assets purchased under hire purchase agreement. And interestingly, we're going to talk something about hire purchase agreement today. Then we also look at assets purchased on lease. So these are two exceptions. We have operating lease and finance lease. We also went ahead to talk about the types of capital allowances. We said we have initial allowance, which is the first allowance you got when you buy an asset. And we said it is not prorated. It is taken once in a year. The first year the business asset was put into use. We also said that annual allowance is done annually over the life of the assets, the useful life of the asset. And now the useful life of the asset is determined by the tax authority. Unlike depreciation, that the company might decide that they want to use a different depreciation method, but here the tax authority gives you the number of years this asset should be used. So we talked about how to calculate the annual allowance. We said the annual allowance is calculated after the initial allowance. So what you do is that you will bring the cost of the assets less the initial allowance from it. Whatever you get, you spread it out in straight line method on the assets, the number of life of the assets. So that's the annual allowance. We'll talk more about it again. We talked about the investment allowance. Investment allowance is only granted to any asset called plant and machinery. It is 10% of the cost value. and it does not go into the solution to reduce the value of the assets. Then we talked about balancing allowance and balancing charge. Balancing allowance has to do with the allowance you get when you sell your assets, and what you sold it for is less than the net book value. We call it tax written down value. So your tax written down value is, say, 1 million, and you sold the asset for 800,000. That means you did not make up to 1 million. And so that 200,000 naira difference is the balancing allowance that you can claim. We now said balancing charge is the opposite, is when you sell above your net book value, or we call it tax written down value. You sold for 1.5 million. So the 500,000 extra is a balancing charge that you have to charge tax on. Then we talked about the rural investment allowance that you get where you provide amenities in rural areas. So we now went ahead to do one example. Look at the capital allowance rates, which you must be given in exam. And by now, I believe that you must have studied it, because we'll be looking at this. So if I were you, I will make a screenshot of this and keep it somewhere, because each time you need capital allowances, you go to this place and get it. We now said the basis period for capital allowance should run with that of basis period for taxation for assessable profits, except when we have overlap period and gaps. But we find out that in capital allowances, there is nothing like gaps. All we need to do is to smoothen out the gaps. So the law for capital allowance is that if year, I call this one year X, and year Y, there is a basis period that overlaps. That overlapped period belongs to the earlier. So if year X is before year Y, and there is a overlap, there's an overlap between X and Y, then that overlap period would have been settled in year X. So when we get to year Y, in capital allowances, you will not include that. Now, if there is a gap between year X and year Y, now that period of gap will belong to Y. That period of gap, because it will not have been settled in X, it will belong to Y. Except if there is a basis period, or if there is cessation of business. If there is cessation of business, then that gap will belong to X, because X obviously would be the penultimate year, while Y will be the ultimate year. And so if there is in penultimate and ultimate year, there is a gap, that gap belongs to penultimate year. But in commencement rule, if there is a gap, if there is an overlap between X and Y, it belongs to X. If there is an overlap between Y and Z, it belongs to Y. So that's the rule for capital allowances. So now we looked at this question 1, which by now you saw those examples I gave you. Then we looked at question 2. Question 2, we are given a statement here that the company was incorporated in March 15, 2001, and look at the accounts for 2002 ending, accounting date ending 2002 March, 2003 March, and 2004 March. And we now saw the capital expenditure, qualifying capital expenditure. We were told to determine the basis period for assessment and for capital allowance for 5 years. And we said that this is it here for 5 years. We are just using the normal basis period. So if you look at the first year is year 1, year 2, 2002, year 3, 2003, year 4, 2004, and year 5. For that of profit, we know that it is from the date the business commenced, because even though it was incorporated in March 15, it started in June 1. So you see, from June 1 down to the ending of December, you find out that that is your year 1. The same thing for capital allowance is for year 1. Then we go again for year 2. Year 2 begins from the date of business commencement. That's the law. And it works 12 full months. So this 12 full months. Now, if you notice that there is an overlap between year 1 and year 2. So if you look at it, can we find June 1, 2001 in this place in year 1? If we can, that means there is an overlap. So what is the overlap period? So you know that this date is common here. All right. Can we find this last date here? No, we can't find it here. That would mean that while there is an overlap, this second year extends much more than the overlap period. So what we do is this. We look at the last date. We look at the last date of this first one. So we say that the overlap will have ended here. And so the next day after it, January 1, will be where the capital allowance basis period will start, and it will all end here. So that way, there is no overlap, because we said if there is an overlap, it would have been settled in the first period. So anything from June 1 to 31st December would have been settled here. So what has not been settled is January 1 to this date. We look at the year 3. In year 3, we find out that we're looking at the ending of the end date of the business to start our accounting. You know the business ends March 31st. It ends March 31st. But we cannot achieve 12 full months in year 3. And so we decided to repeat that of year 2. So everything here in year 3 is an exact repetition of year 2. So it's an exact overlap. So that means you can find this date in year 2. You can find this date also in year 2. So there's an overlap that has been settled in this period. So you see here, there is nothing here. There's nothing here. So that means because the overlap has been settled here. Then in year 4, the preceding year basis would have started. So you look at it, this is your 2004, it's your year 4. Preceding year basis means your basis period must end in 2003. Now, what is the company's year end? 31st March. So you put 31st March. Now, if it's ending 31st March 2003, it must have started in April 1, 2002. And I gave you a small hint that because this is 2003 and it's not December 31st, here must be 2002. Then I said, because here is 31st March, you ask, can we find April 1, 2002 here in this date here? Can we find it? Of course we can, because here ends in March 31st and May 31st, 2002. So April comes before May. So April can be gotten here. So there is an overlap that must be here. And we know here and here are the same thing. So there must be an overlap. Now, look at this date, 31st March 2003. Can we find it here in any of this period here? No. That means your ending date is not an overlap. So you put down your ending date to correspond. That is it here. Then we said, since there is an overlap from the beginning of the year, we'll look at when did the last basis period for capital allowance stop. It stopped at 31st May 2002. So for it not to be an overlap, the next one must start with June 1, 2002. So you see from June 1, 2002, it goes. Then we go to 2005. In 2005, what happened? You see, this is 2005. The ending year must be 2004. We say it is March 31st, our calendar account ending date. So it must have started in April 1 of 2003. So we ask ourselves, can we get April 1, 2003 here? No. So there is no overlap. As long as this first date cannot be gotten from the previous one, then there is no overlap. So you see here, you see this date here being repeated, everything repeated to show you that capital allowances must follow the date, the basis period of accessible profit, except where there is gap or overlap. Now we look at all those assets that we put here. So any asset you see here that was bought between this period of basis period for capital allowances are being put here. We are putting these assets here for the sake of initial allowances. So we went ahead to show you the workings for the initial allowances. Okay, we are asked to compute the capital allowances due for 5 years in respect of the qualifying capital expenditure. So what we did was we now did a copy and paste of this basis period for 5 years for capital allowance. We brought them here. We brought the basis period here. You can see that it's an exact replica. And we brought the qualifying capital expenditure here that we put here. We brought it down here. You see, it's an exact replica. Then we now said, this is the initial allowance. This is the annual allowance. Okay, sorry. This is the initial allowance for each of these assets. And look at the annual allowances for them. And we find the total. So let's look at how we got the initial allowance for 2001. So we said we are even bringing factory building, machinery, and furniture. The initial allowance is 15%. So you look for 15% of the qualifying capital expenditure. We have this. We look for the 50% of this qualifying capital expenditure, and we have 1,400,000. We look for 25% of the qualifying capital expenditure, and we got this. So that's how we got those figures here. And that is how you will do in all of them. Now the annual allowance, okay, look at 2002, year 2. That is how we do for van. We got the initial allowance for van, same way. Motor vehicle, we got them the same way. In 2003, there was no capital allowance, no initial allowance. Yeah, no initial allowance. In 2004, we found equipment. Look for the initial allowance, 50% of it, of the qualifying capital expenditure we got. That's how we got all these figures here. Then we'll go to the annual allowance for year 1. So let me start with year 1. Look at this factory and building. the qualifying capital expenditure is 3,500,000. So after getting the initial allowance, you remove the initial allowance from the costs. That is what I did here. Initial allowance, cost minus initial allowance. You get a figure. Then, because the annual allowance of factory building is 10%, it means 100/10, which technically means 10 years. So I just do 100/10, but another person can skip this 100/10 and just say 10. So when you minus this from this and you divide by 10, you are getting this figure as your initial your annual allowance for each year. But you know, this is the first year. You have to prorate how many months that you have used the asset for the first year. So we now prorated this figure here because it's for 10 months. We say 10/12. So this is what we are charging the assets for the first year. Going to the machinery, this is the initial cost of the machinery which we saw here. Now this is the initial allowance which we are deducting, which is what we got here. When we deduct it, everything remaining will be for annual allowance. And we said machinery is 25% annual allowance. So it means 100/25 is 4 years. So when we get 25%, it means 4 years. So you are doing this figure divided by 4 years, you are getting 350,000. And we said for the first year alone, you have to prorate this 350 to the number of months that it was used. The same thing happens to furniture. Now when we get to year 2, those assets we bought in year 2 of our business, that asset has started their journey from that year. So for that asset that was bought that year, that is year 1 for that asset. So for that asset that was bought on that year, you must look for initial allowance and you must look for annual allowance. So in 2002, we had initial allowance of van here, which we got, which we are now looking for the annual allowance for 2002 alone now, because that's the first year the van is in existence. So we'll come here, the cost of the van in that year minus the initial allowance for that year we calculated, which is this figure. Now, van is 4 years, as we can see. So we look at it that this is what is the annual allowance for van. But because this is the first year of that van, we are prorating the van for this year alone. So we used it 2 months out of 5 months. So it was here 2/5 of this figure. So we got this. Now, we also looked at the motor vehicle that was bought in that year. We did the initial allowance and we did the annual allowance. The initial allowance was 600,000. We did that. So we are minusing it from the cost, dividing by 4 years again. We got 150 and we are prorating it. We use it 1 month out of 5, which is 30,000. Now, these 2 vehicles, these 2 assets was bought in the year of assessment 2002. But what about these ones that have been existing before? So the other assets purchased in the year of assessment 2001 will have their annual allowances charged in full. What we mean is that we are not going to prorate again for factory building. We are going to take the whole of this 297,500. We are going to take the whole of this 350,000. We are going to take the whole of this 122,500. We are going to now add them. So look at what we did here now. This is exactly what I did. I now brought them here and I add them up and I got 760. So 760 becomes my annual allowance for the other assets. So look at what I did here. For year 2002, so motor vehicle delivery van was bought. Look at this initial allowance as we got it. Motor vehicle was bought. Look at the initial allowance as we got it. When we add these two, we got this as initial allowance. Now the annual allowance for delivery van was this as we calculated. The annual allowance for motor vehicle was this as we calculated. Now this one is for the others, which we calculated here. This 760 is the others we calculated. So what we did was to add the 760. So we calculated all of this to get 815 as our total annual allowance. So when we add our 815 to 850, this figure here will be the total capital allowance we are going to be considering. Now let me look at 2004 again. In 2000 year of assessment, the year of assessment 2004, 2003, sorry. In year of assessment 2003, you will notice that there is no basis period. This is for initial allowance. This is for initial allowance. So no asset was bought. So you see there is no initial allowance, but there is annual allowance. Let's see how we calculate the annual allowance for 2003. We said all the assets purchased in the year of assessment for 2001 and 2002 will have their full annual allowance charged in 2003. So you remember assets that we bought in 2001, remember this 760? Yes, you remember this 760 from assets purchased in 2001. Now, asset purchased in 2002, we know is delivery van and motor vehicle. So now this was the figure we prorated. This was the full figure before we prorated. This was also the full figure before we prorated. Let's see if we can confirm. Yes, this was the full figure before we prorated. This was the full figure before we prorated. So we are not doing prorating again. We are charging their full value. So for the second year of this asset, which is the third year of the business, you see, you are adding these two to these two to get 212,500. So this is for 2002. When you add this figure to this figure, you are getting 972,500, which is the stuff we got here. So when we add this to 0, we get the same thing. For 2004, we know you only bought one equipment. So this equipment will start having its life from that year. So that is the year 1 for office equipment. So what do? We do as we have been doing before. In 2004, we have already calculated initial allowance of office equipment to be 300,000. So that's this 300,000 here. So let's see what we can do further in 2004. So we say office equipment, the cost is 600,000 minus the initial allowance of 300,000. It has a 4-year lifespan, gives you 75,000. Annual allowance 75,000. But this is the first year of the asset, so we prorate it accordingly. So when we prorate 3 months out of 10, we have 22,500. For this year, the asset was bought. So that's the annual allowance for office equipment. So see what I did. We'll go down here. Office equipment, look at the initial allowance is 300. Look at the annual allowance that was prorated is 22,500. And now, do you remember this 972,500? That is the whole of the orders that we gave out in full. You know, no asset was bought here. So here, every asset was, before this date now, was being charged full. So I brought the full annual allowance and I brought it down here. So when we add this down to this, you are getting this value 995,000 as your annual allowance for the year. When you add it with 300,000, you are getting this full amount as your capital allowance. Now let's look at 2005. For 2005, we didn't buy any assets. So all we need to do is start bringing the annual allowances for all the assets bought. For 2001, you remember this 760, that's fine. For 2002, you remember this 212,500. This is the assets bought in that year. Look at the full charge. You remember these two figures? And you remember that we got this figure 972,500. You remember that? Fine. For asset purchased in 2004, we got this here as our full value. So if you have to add this to this, which is another way of saying this figure here plus this figure here plus this figure here will give you this young man here. So that is how we got our final figure here, and there is no initial allowance, so it becomes our annual allowance. That's for that. Then we went ahead to say that the question says computation of tax liabilities for the first 5 years. And now we are giving assessable profits. Now the assessable profit was given for 10 months. The first one was from when the business started. Okay, let me leave this solution here and look at the question yes that's to be. Sorry, hold a moment. Okay, now the business started 10 months ending in March, so it must have started in June. So we are looking from June 1 to December 31st. How many months is that going to be? 7 months. So your first year is going to be 7/10 of this first year figure. That's this figure here, 7,500, 7,500,000. So that's what we got here. Then your capital allowance is that total capital allowance we got for 2001. So let me just go up and show you. Is this figure. So is this figure that this side will be taking our capital allowance figures. So that's the capital allowance we got here. When we did that, we deducted and we got a value here. This value is called taxable profit. So taxable profit is what you get when you remove capital allowance from your assessable profit. And what do we do? Our income tax is going to be 30% of our taxable profit. So you see 30% of this figure gives us this. And our education tax is going to be 2% of our assessable profit. And that gives us this. So when you add these two, this is your total tax liability. It's optional for you to add these two. It's not compulsory, you must add them. Now when you go to 2002 year of assessment, all you need to do here is you are starting from the first date of business and you count 12 months. So, you know, the first one is 10 months and you need 12 months. So you have taken the first 10 months. So you need 2 months figure from here. So you say 2/12 of that figure. So that's what we did here. Add to our 7.5 becomes 9.5. When we take our capital allowances and deduct it from that, we have this 7,835,000. Now we know our income tax is going to be 30% of this figure. We get 2,350,500. Our education tax is going to be 2% of this figure. So we did it, we have 190. Now we'll go to the year 2000 and the third year, 2003. We know that we did our basis period exactly the same as that of year 2, if you remember. And so we are going to be getting the same value here as we got here. But our capital allowance is what changes things. We said our capital allowance was 972,500. So when we minus, look at what we are getting. So don't assume that because you have the same accessible profit, you must have the same capital allowance. No, because of overlap and gap purposes. Now, look at your income tax. Your income tax will be 30% of this figure, which gives me this. While my education tax remains 2% of 9.5, which will give me what we got before in the previous one. So that's for year 3. If you go to year 4, you find out that it's preceding year basis. And so there's no adjustment. April 1, 2002 to March 31st, 23. So you see an account ending in March 31st, 23, 12 million. Take that straight. Take it straight. Then your capital allowance, you bring it from our calculation. Then you minus, you get this figure. That's your taxable profit. You find 30% of it. That's this figure. Find 2% of accessible profit. Got 240. For 2005, you take the figure straight. There's no adjustment. Take it straight, no adjustment. That's the figure here. Then if you remember our capital allowance there, you deduct, you get your taxable profit, look for 30% of it, that's your tax. And you look for 2% of your accessible profit, that's your education tax. And I gave you an assignment to do the same thing using right of election. That will mean that I only want you to do year 2 and year 3. Year 2 and year 3. That is where the right of election is really based. So I'm not asking you to do the whole 5 years. I'm asking you to do right of election only happens in the 2nd year and the 3rd year. But you can still do everything, just to be sure. Yeah, you can do everything. Do everything. Don't do only the 2 years. Now, basis period, when there is a gap, I've told you about it, is when there is a gap, the gap affects only the 2nd period, except when there is a cessation period, that it goes to the earlier one, which is the penultimate. Now look at this example question here. We now said Chopping Stick Nigeria Limited is engaged in this catering business. Its recent account showed the following adjusted profits. And we looked at the profit here. This is 280. This is 360. Now look at it now, yeah. There is a year ending here, 30th of September. Year ending, of course, when you see year ending, you know it is full year, 12 months. Now you are seeing 15 months to, you know that's the cue for change of accounting dates. So what do? You look for, you're asked to find the compute the accessible profit for the relevant years. Now, what you do is you look for the year in which the change occurred. Obviously, this year ended 30th September 2001. Because it's ending in 2001, it is 2002 year of assessment. And so this is the basis period which coincide with this. So the accessible profit is this one, no doubt about it. Then the next one, since it is ending in 2002, the year of assessment should be 2003. So that's what we did here, ending in this period. No doubt about it, is the accessible profit. Now, the problem lies with here. Year of assessment 2004 is supposed to be ending on on September 30th, 2003. And there is no September 30th, 2003. It extends up to December 30th, so 3 more months were added. That is the year of change. So what do? That is our first year of change. So you see me here writing first year of change in 2004 year of assessment. And you give the basis period based on the old accounting date. And what is the old accounting date? 30th May, 30th September. So you see me based on the old accounting date. This is the old accounting date principle, 30th September. What is the assessable profit? They give you 15 months. So you look for 12 months out of it. And we got 420 here. The second year of change is based on the old accounting date. So you look for where we have October 2003. October 2003 will be inside this 15 months account because we have October, November, December. There is 3 months here. So you see me doing 3 out of 15 of this figure. Now we've gotten 3 months. So we'll take the remaining 9 months here. So you see 9 over 12 of that figure, and you got this. Now the third year of change, you need to look at the basis period. We have up to 30th September, but 2005. So there is nothing here that relates up to 2005. So we don't do this one. So you now go based on the new date. So this 2002 and 2003 is the same replica here, no problem. This is the first year of change based on the new date. The new date is December 31st. So they started from October, November, December, and went to the whole year again. So we are taking 12 months out of it. So we took our 12 months and we got our 420. The second year of change, we are supposed to look from January 1 to December 31st. So did they give you anything January 1, 2004? Let's see. January 1, 2004 to December. So it's supposed to be this 780 here. So it's supposed to be 780 here. So you can see is this 780 that we got here. Oh, sorry. Second year of change is what? 2005 is the second year of change. So it should end in 2004 December. So where can we find January 2004? We should find it here. And December is this. So it's just this 728. So there was no need for these workings. There was no need for all these workings. So it's just this 728 you put here. So that's it. Now we are asked to look for the final basis of assessment and the basis for capital allowances after determining the final assessable profit for 2002 to 2005. So what we do is that we did a copy and paste of basis period for 2002 to 2005 year of assessment. I just included 2006 here too, but it's from 2002 to 2005. Now, the copy and paste is as a result from which one is acceptable here. So we look at this figure, these two figures, 420 and 728. If you add them together, and 420 and 651, which one is bigger? Find out that based on the new date, tax authority will charge you higher here. So you see here that this new date is bigger. So what we did is we copy everything based on the new dates. So that was what we did here. The first two, there was no problem ending on the old dates. Now, the first year of change, we know that the new dates based on the new assessment, the tax authority will favor that of the new date. So I put the date here, I put the second year of change here, and the third year of change here, the new dates. Now look at the capital allowance. Let's see whether there is gap or whether there is overlap. I said the first one, there will always be the same because that's just the first period. You have not gotten any information before. So that's the first period going to rhyme. Second one, is there going to be a gap or overlap? So you ask yourself, this first date here, can we find it inside the 2002 year of assessment? No, we can't. As long as you cannot find this first date here, everything, there is no overlap. There is no overlap. And when you look at it, did it start the next day after this? If it starts the next day after that, then that means there is no gap, there is no overlap. That means you repeat it. Now you go to the first year of change. Let's look at this date. Can we find this date here? January 1, 2003 cannot be found here. Then we'll ask ourselves again, if we cannot find January 1, 2003 here, then did this start where this one stopped? This one end in 30th of September? No. So we must start from October. So you see here, October 1, this should be 2002, please. October 1, 2002. That is where this one ended. This one is starting from there. And it's going to end where this ends, 31st December 23. So it's because I was doing copy and paste and adjusting. That's why I make this stupid mistakes. But in your exam, don't make this mistake. This is 2002. So you check again. Of course, the second year of change, there will be no overlap because it will start from where this one stops. And that is exactly what we did here. There is no overlap here. So the third year of change, this one starts where this stops. And sorry, starts where it stops. So everything is in line. So the only change occurred in the first year of change. And I told you when you are using based on the new accounting dates, it's only the first year that will be seeing workings because there's a change. That was where we ended. So today we are going to be looking at restriction on capital allowances. Now, sometimes when you are calculating capital allowances, you find out that capital allowances are restricted. There is an amount that you should take as capital allowance. The restriction on capital allowance is 66 to 3% of the company's accessible profit for the year. What I mean is this: when you add your initial allowance, your investment allowance, your annual allowance, your balancing allowance, and any unabsorbed capital allowance that you brought forward, and you totally that this is my total capital allowance claimable. How many can you claim or relieve? So you have to be doing tests. The test is check 66 to 3%. Notice I use the word percent. 66 to 3%. Some people will not be using the word percent. If you don't use percent, you are going to get it wrong. 66 to 3% of your accessible profit for that year. When you find out that if the 66 to 3% is smaller than what you are claiming, then you have restricted it. Now, just to be on the safe side, because some people will forget to put percent. 66 to third percent is the same thing as 2 over 3 without percent. Now look at the proof I gave you here so that you will always be doing the right thing. Prove that 66 to third percent is equals to 2 over 3. Now, when you want to do 66 to third percent, we know that this 66 to third percent means divided by 100. So I am removing this percent by saying 66 to third divided by 100. So that's how I removed it. Now, this 66 to third, change it from a mixed fraction to improper fraction. So let me bring my calculator here so that we can be doing the same thing. Sorry. Let me get my calculator. So while I'm getting my calculator, we know that 66 to third, ouch, sorry. Just a moment. Okay. Oh God. All right, so let's do it together now. 66 to third is the same thing as you say 66 why is this thing stiff? 66 multiplied 66 multiplied 66 multiplied by the denominator, which is 3, will give you 198. So when it gives you 198, you add it to the numerator, which is 2, gives you 200. So you say 200 over 3. So this 66 to third alone has given you 200 over 3. Our divided by 100 is still here. I'm taking the time to do all of this because I know most accounting students are not mathematics students. So 200 over 3 divided by 100, when the time you change your divide to times, it means it will be a reciprocal of 100, so it will be 1 over 100. So it's as good as saying 200 multiplied by 1 will give you 200, and 3 multiplied by 100 will give you 300. So we have 200 over 300. If you cancel this 0 with this, you get 2 over 3. So 66 to third percent is the same thing as 2 over 3 without the percent. So look at it now. Hence, while you may quote the law of restriction as 66 to third percent of accessible profit, you can use 2 over 3 in your calculation. Also note that 66 to third percent has a percentage sign in it, while 2 over 3 is just a fraction. So instead of you to make the mistake, you can forget about the word 66 to third percent. Just always say your restriction is 2 over 3 of accessible profit. That's all. Now, which companies are restricted and which companies are not? Now, companies in the agro-allied industry, that means you are into agriculture, you are not restricted. That means, what it means is that all your capital allowances will be charged, will be claimed as much as your accessible profits can take. Unlike the people who get restricted, they can only claim as much as 2/3 of your accessible profits can take. Another people is the manufacturing industry. The manufacturing industry are not affected by the restriction. Now, henceforth, you'll be seeing some restrictions apply. So when you look at a company, all you need to do is you ask yourself, is this company a manufacturing company? If it is a manufacturing company, you say no restriction. Is this company an agricultural company? If it is, no restriction. But if you cannot see these two, every other ones, we have a restriction. Then we have carry back of capital allowances on cessation of business. So we have been discussing capital allowances in terms of when we start a business, and we saw the overlap problems, and we smoothed them out. We have looked at change of accounting date, where we saw the based on new accounting date and based on old accounting date. Now we are coming to when the business is ceasing. On cessation of business, you find out that because of downturn of the economy, you may not be making profits. And because you are not making profits, you are making a loss, and you cannot be charged tax. And not only because of that, you have unabsorbed capital allowance. That means you have capital allowance that should be claimed. And because the business has ended, normally any capital allowance you cannot claim, you take it to the next year. So let's say I started business in 2010, but have a capital allowance I cannot clear in 2010, I take it to 2011, and I continue like that. If in 2019, my business came to an end, and I have capital allowances that are not cleared, there's no way I can take it to 2020 because there's no business. I've ceased business. So what should we do? The law favors capital allowances to be reclaimed or to be claimed by taking it 5 years backward. So in 2019, I ceased business. That is my cessation year, my ultimate year. So when I say I'm taking it 5 years backward, it means I should start counting from my penultimate year. Mind you, my penultimate year, I have charged tax before on my profits. And so what happened is that I will go back to my penultimate year and start counting. I will bring back my taxable profit. I will return the tax that has been charged. Or what I will do is this. Yes, I will return all the tax that has been charged to it, so that I will get my taxable profits, total taxable profits. Then I will now remove the other capital allowance that has been brought backward. So what it means is that I have already been charged tax. I'll bring back my capital allowances brought backward to the total profit that I have before I charge the tax. So I'll bring back my capital allowances and charge it. When I charge it and it's not enough, I'll carry it back to the other year before. I'll do the same thing. Now, what it means is that this carry back of capital allowance, government is refunding you your tax that you pay so that you can claim capital allowance. In implication, in all technicality, that is what should be obtained. But in the real sense, once money enters the government hand, they don't give it to you. So they will look for every other way for you to tag something that will be used, that money will be used, because they won't give you. But let's leave what happens in the real life. You want to pass your exam. So technically, the government are refunding you your tax. So what it means is that you go to your taxable profit before you charge your tax. You bring back those capital allowances that you are carrying backward, and you clear it off. You take it to 5 years. If on the 5th year you cannot absorb all that carried back capital allowance, then you cannot take it backward 6 years. it means it has lapsed. That means the remainder will be lost and lost forever. Let's see if we can see an example of this carryback. So we have Energy Resources Limited is a company engaged in the incorporation and sale of new electric cookers. So they are not a manufacturing company. So they are not manufacturing, they are not agro, they are not into that. You say there is going to be a restriction on capital allowance. Now, the company ceased business on what date? 31st July 2008 due to stiff competition from importers of fairly used cookers. So what two things are we looking at from here? This is a company and not a business name. It's limited. Second, that means you have to be charging them company income tax. Secondly, there is no restriction on capital allowance. There is restriction on capital allowance, so you'll be looking at 60 or 2/3 restriction. Thirdly, our ultimate year is 31st July. Is 2008 is our ultimate year. That means our penultimate year is going to be 2007. 2007 year of assessment. Now that's it. Now look at the recent results reveals the following. Look at year ended September 30th. So because they say year ended is a 12 months period. So all these are 12 months period, but here is a 10 months period that ends in this. So now when we say 12 months period, when did they start? They would have started October 1. So this account would have started October 1, 1999 and ended in September 30th, 2000. This account would have started October 1, 2006 to end September 30th, 2007. This account would have started in October 1, 2007. Let's count. October is 1 month, November 2 months, December is 3 months. From January to July is 7 months. So add it to that 3 is 10 months. So they are correct. 10 months, this figure. Now look at the capital allowances. It is interesting to note that capital allowances started from 2001 and end 2007, but profits start from 2000 and end 2008. So why the difference? Now, I want you to note something here. There is a difference between year ended and year of assessment. The difference is this shows you the year, the tax year, the year of assessment, the year that the tax people comes to check the books, the time you file your tax. This is your basis period. So it means that a basis period that ends in 30th September 2000, the year of assessment is 2001. So in another sense, this year of assessment 2001 rhyme with this year ended basis period 2000. So don't get confused, because some people will say, what will I do with this 2000? There's no 2000 figure here. Some people will not start matching 2001 with 2001. It's wrong. So this 2000 is the basis period ending in September 30th. So the basis period, the year of assessment, must be 2001. So this 2000 year, 2001 to match. So just be looking at the heading to be sure, because they can give you year of assessment here and give you year of assessment here. I will give you the same. And don't come and tell me, Prof. Chima said always be looking at 2001 to 2000. Look here first. Year ended. Make sure it's year ended and assessment year. Capital allowance, they will always give you year of assessment. But for profit, you have to check if it is year of assessment or year ended. If it is year of assessment, then the two of them will match. If it is year ended, then you will do what I am telling you now. That means this 2006 here is for 2007 year ended. And that means this 2007 is for this. So you see, let's count. 1, 2, 3, 4, 5, 6, 7. And here we'll get up to 9. 1, 2, 3, 4, 5, 6, 7, 8, 9. You get why. So let's look at it now. Balance allowance after disposal of all companies' fixed asset on cessation of business amounted to 2,350,000. Now required, compute the company's income tax liability for 2001 to 2008 assessment years, giving all relief as much as possible. If you are just coming in now, if you don't know anything about basis period, or you know a little about basis period, this question is going to refresh you. If you don't know anything about capital allowance, this question is going to refresh your memory. And we are also doing a carry back. Let's look at it. Okay, let me go to my solution. Page 16. Just go straight to page 16. Okay, so let's get this. This is the question here. Let's get our solution here. Now look at your solution. We are asked to find the computation of income tax liabilities for 2001 to 2008 assessment year. Now look at year of assessment and basis period. This is description. This Naira sign shifted. I don't know why. Now, assessable profits for 2001. So you see, the basis period must have ended in 2000, September 30th. And we'll go to where they say year ended. So 2000. So yeah, you're not doing adjustment, you're bringing the whole figure, 18. That's it here. Now, look at your capital allowance claimable. You ask me, how did I get this capital allowance claimable? Okay, I'm going to show you how I got my capital allowance claimable. Yeah, that's it. 1,950,000. So you see 1,950,000 here. So what do? How many can you relieve? So what you do is that all this, you ask yourself, all this capital allowance that I want to claim, is it possible I can remove all of them from this profit? I don't think it's possible. Now we said there's going to be a restriction. All you need to do is this. You will say, let me compare this 1,950,000 with 2/3, 2/3 multiplied by 1,800,000. That will give you 1,200,000. So the restriction is you cannot remove more than 1,200,000. Now, can you see that I put it in two places? In your textbook, you will not see it like this, but this is a simplified way for you to understand. Because going by what the textbook will give you, you may not understand. Now, this 1,200,000, I'm putting it in two places. There is a reason why. The first one I put here is under this capital allowance. It means this is what I have brought to be relieved. This is what I am relieving. So when I remove this from this, what I am left here is 750. Let's do it together. 1,950,000 minus 1,200,000. So I have 750 as the capital allowance that will be carried forward to the next year. This is unrelieved. Then I'll go again. So this 1,200,000, I want to relieve it now from my profits. So here I was deducting it from capital allowance to see how many is the balance. Now I am relieving it from my profits. So since I have to relieve from my profits 1,800,000 minus 1,200,000. That means my taxable profit after I have deducted my capital allowance is 600. Note, you are not relieving it 2 times. You are not relieving it 2 times. This is where you are relieving it from profits. So you have a taxable profit of 600. But here you are merely saying, after I have relieved it, how many is left? So after I have relieved it, so it is under profit you are relieving. Here you are deducting, so okay, this is the amount I've relieved from the claimable capital allowance. How many am I taking to the next year? So that's it. Now your company income tax is going to be on the as taxable profit of 600,000, which is 180. Your education tax. Now you always be doing education tax whenever it is a company. How do you know a company? You see limited or PLC. So as long as you do company income tax, always do tertiary education tax, whether you are told or not. So if you miss it, it means you don't know the principle. They might remove half mark. So that's that for the first year. You go to the second year. The second year, look at what happens. 2002, basis period ends in September 2001. So you go to basis period ending in September 2001, and you take the assessable profit there, 2,300,000. You bring it under this side, 2,300,000. Now you come to capital allowance. Can you see that this was carried forward to next year, and now we are bringing it forward? So we are bringing our 750 that we could not relieve last time, brought it here. Then you go to the 2002 assessment year and bring the capital allowance for the year 920. So that's this 920. When you add these two together, let's do it together. 750 plus 920, you are getting 1,670,000. And that is what I got here. That's fine. How many of these can you claim, that can you relieve? So you ask yourself, you always be comparing this figure with 2/3 of this figure here. So that's what I just did in my calculation here. 2/3 of that figure is going to give me this. And I'm putting it in 2 places. Here is actually where I am relieving it. So when I remove it from here, my taxable profit will give me 766.67. But when I put it here, it means after I have relieved it, how many is left that will be carried to the next year? And that's this figure. My company income tax will be based on 30% on this, while my education tax is going to be 2% on this, so don't mix them up. That's what I did. So I told you it's not compulsory you add them together, you separate them, because in principle you're not paying them in the same account. Not paying them in the same account. But you might use one check to pay all of them, but they are going to go in separate accounts. We'll go to the next year. Now, assessable profits, basis period, don't forget the basis period and the year of assessment and basis period. It carries a mark. So you take the one that has 2002, 3,500,000. So this 3,500,000 is what is here now. That's assessable profit. Now, this one that was left, brought it down here, that's brought forward. Then the one for the year, you go to 2003 and check. That's the one for this year, 1,350,000. Bring it down here, 1,350,000. You add these two together, you get this figure. Now, what did I do? Relieve it. Let's see what will happen when we say, now this figure is smaller than this, but you still need to check. So you say 2/3 multiplied by 3,500,000. Sorry, why am I getting minus? 2 divided by 3 multiplied by 3,500,000. I'm getting 2,333,333. So this is even less than the restriction. That means I can relieve all. That's what it means. So you see, I didn't do 2/3 anymore, because the 2/3 is bigger than what we have. So you see, I am relieving everything here. And when I relieve it, that means there's nothing to carry forward. I am bringing it here for the actual relieving, and this is my total taxable profit. So my income tax will be based on that, which is this. My tertiary education tax will be based on this. So 70. Now we go to the next year. The next year, we have assessable profit. We go straight to the one of 2003, which is for year of assessment 2004, 1,500,000. So that's what I'm going to bring here, 1,500,000. Capital allowance, you see there is nothing brought forward from the other year. So all we look at is what is being charged for the year 2004, 870,000. So that's what I'm taking. So when I put it down here, I will still check 2/3 of assessable profits of 1,500,000. You give me 1 million. So that means I can remove the whole of 870, which is smaller than 1 million. So I'm removing the whole of 870, putting them here too. See, there's nothing to carry forward. But when you put it down here, the purpose of here is to know how many to carry forward. Here is to know what is your taxable profit after relief. So you put it down here, 1.5 million minus 870 gives you 630 as a taxable profit. You look for your income tax, look for your education tax. You go to the next year. We look at it again. 1.7 is the figure you're going to use here. Thank God there's no adjustment. Okay, now 1.7 is here. Then you come to your capital allowance. It's going to be 850. 850. So we are now going to compare 850 with 2/3 times 1,700,000. So you always be doing it. So this is 1.1 million. So it's less. So you remove your old 850. You remove it here, you remove it here. When you remove 850 from here, it gives you 850. Your taxable income is 850. Company income tax is taken from that 850. So we'll go to the next year. We are seeing something similar. You see that the assessable profit is bigger than the actual capital allowance for that year, and when we look for 2/3 of it is bigger than the capital allowance available for relief. So we relieve everything. You have 0 here, bring it here, you have 470, the same automated process. Let's go to the next one that is interesting. Penultimate year, 2007. And I say, use the AYB. AYB and PYB is what we are giving. PYB is what we were given. And 2006 year of assessment, 2007 year of assessment, company ending date 2006. So we'll go to 2006 and bring your 950 here. Your 950 is going to give you assessable profit. Note where I put it. 950 is here. I put it. Then you go to the actual year basis. Actual year basis, it will be from January 1, 27 to 31st December 27. Where can we find January 1, 27? We can find it here. Mind you, this account started from October 1, 26. So let's look at October 1, October, November, December. So 3 months out. So we are left with 9 months from January to September. So I'm going to take 9 months out of 12 of 780. Then the remaining 3 months, I'm going to take it from here. So 3 months out of 10. So 3 months out of 10. So when I add these two up, I get 660. So what will the tax authority choose? They will choose the one that has the higher figure. So the one of higher figure is the AYB. I put it to the side. So here you have decided which of the accessible profits goes here from these two, the higher of the two. Now, because you have chosen PYB, you are going to, your capital allowance will follow suit. So this is year of assessment 2007. What is your capital allowance for 2007? 950 also. So you are bringing 950 as your capital allowance. Can you relieve everything? Of course not. You can't relieve everything. So what you do, you look at 2/3 of it. This is what you are relieving. This figure is there, this figure is here. Because this figure and this figure are the same. That's why you're seeing this figure here, the same with this figure. Now this figure is a taxable profit. This figure here is what you are carrying to next year. Now let's go to the actual year of cessation. This is where the fund arises. Now, your actual year of cessation, you have your profit. Here is 10 months. That started from October. But you know your actual basis period will be from January 128 to October to July. So this is just actually 7 months. So you're taking 7 months out of the 10 months. That gives you 175. Now your capital allowance, look at what will happen. This capital allowance that you carried forward is what is brought here. That's fine. Capital allowance for the year. Let's go down. We are not giving capital allowance for the year, but we are giving balancing allowance. So it's form part of your capital allowance. So you bring it down here. So every of your allowances, you add them up, you get this. Now when you get this, this is the amount that is claimable. So look at it now. In this last year, you are not going to do 2/3 anymore because this is bigger than your capital, your accessible profit. You will not make profits. You are not going to be charged tax. Your capital allowance is still unclaimed. So what you do is, if you relieve this one, the whole of this profit is taken to be here, so that when you get here, this will knock off this to make it 0. So you have relieved this part. You have only relieved 175 in the year the business ended. So this is what is unrelieved. So this 175 makes your profit 0. You are not paying income tax, or income tax is 0. You're only going to pay education tax because you declared accessible profit of this. So you pay education tax, but your income tax is 0. Now, what happens to this figure? You are supposed to move it to the next year, but the law says carry it backward for 5 years, beginning from the penultimate year. So let's see. Since the capital allowance on the ultimate year is higher than the accessible profit, there will be no taxable profit. This is just what I was telling you. So let's go to capital allowance carried backward. Now let's look at it. We start from the penultimate year. The penultimate year. So let me bring something out for you here so that you'll be understanding what I'm doing. So let me get to penultimate here now. Good. Now, this is carried backward. Penultimate year. This is your taxable profit brought forward This figure was the figure you had before you paid your tax. This is the figure you had before you paid your tax. So that's the figure you're going to bring. Now, what happened is this. You're not paying any tax again. Now, look at your capital allowance brought forward. It is from here. Is this figure. This capital allowance brought backward, sorry. You bring it backward. Previously, you have claimed all your capital allowances before. So you have brought this one backward. What they are asking you is that your remaining taxable profit that is remaining, use it to claim all the capital allowance. So you've done it here. You are bringing it down here again. So your profit is now zero. Your taxable profit now is zero because everything has gone for capital allowance. Everything. So your company income tax will now become zero. It's as good as if they have refunded you that money that you paid for tax. So you see, this one was the capital allowance that was left, that was not charged. You are charging this fraction that the profits can carry. So this is the capital allowance that will be carried backward for the next year. So it means that the tax of 95,000, look at where you paid your 95,000. It means that the 95,000 previously paid has been refunded to relieve capital allowances. The 95,000. So let me just check something here. Let me just check something. Okay, can you see that this is 316,667? That is your relieved capital allowance here. So it means that your tax that you paid, you are grossing it up. That tax was 30% of your taxable profit. When you gross it up, it becomes your capital allowance that should be relieved. In other words, this figure here is 100%, while your tax is 30% of this. So you refund that tax, and you are refunding the tax, and you are taking all of this to clear your accessible profit. So it means that no money for tax for that year because all of them has gone for capital allowance. You now take this figure here to the next year as balance brought forward. Meanwhile, this is not next year, the next year before. I will recall my taxable profits, 470. I'll recall it here. This is 470. It means that this was where our tax was charged. How much did we pay as tax before? We paid how much as tax? We paid 141. So see something interesting. If I say 141,000, normally this 141,000 was as a result of we doing, let me show you something interesting. When we did 30% of 470, we got 141, isn't it? Now, 141 is 30%. So let's gross up this 141. Let's see the gross figure. I will simply say multiply it by 100 and divide by 30. You see, I'm getting 470. So it means I am refunding the tax. So that means that 470 is what I will use as my capital allowance to be relieved. So that's the taxable profit here. It's as grossing up your tax, everything of your taxable profit is being used to relieve your profit. That means they have refunded your tax money. And so you're having zero tax here. This minus this gives you this balance here, which will be taken to the next year. See, this money has been refunded. So you go to the third year. The third year, your taxable profit, let me go up again. Your taxable profit here was 850. That was your remainder of your profit. Your remainder of your profit is your taxable profit, 850. That's it here. You know, we got this 850 as a result of your assessable profit minus your capital allowance for that year. Now we are bringing a new capital allowance. So we are going to, it's as good as saying that your 225 has been refunded. So you look at it, 225,000 times 100 divided by 37, sorry, 255, sorry, 255,000 times 100 divided by 30 is 850. It's as good as you refund everything here, same process here. You less this from this, you get 855. You bring your 855 here, you do the same thing. 630 was your taxable profit, you are relieving it, and you are getting 225. Now count it, this is the fourth year. We started doing this thing here how many years? You'll be getting conscious of it. So this penultimate is the first year, this is the second year, now this is the third year, this is the fourth year. We'll go here, final year to carry backward. This is the final year to carry backward. 2003 year of assessment. So you go to 2003 year of assessment. You bring the taxable profit of 2,013,333. That's what we did here. And you can see that the tax you paid was how much? 604. So it means that our tax is supposed to be refunded. It's supposed to be refunded. But can you see that our balance carried back was 225? So I am not going to refund the whole of 604. I am only going to take this 225 that is remaining. And I'm asking myself, can I relieve it from this remaining profit? By all means, yes. So when I relieve it here, that means there is no capital allowance carried backward. That means I successfully finish it at the last year of carry backward. And I come back here and I do my 225,000. I less it from here. This is going to be my taxable profits. That will mean that my income tax is going to be this figure instead of 604. Instead of 604. Now, what is the difference? Let's do something here now. 604,000 minus what was charged? 536,500. That gives me 67,500 is the tax that was refunded to you. So you see, 67,500 is the tax refunded to you. Now let's see what it translates. If I say 67,500 times 100 divided by 30, wait for it, 225,000, which is this figure I put down here. So you see your tax has been refunded, but here in the last year is the 67,500 tax that was refunded. So look at the comment I made here. This means that instead of the tax of 604,000 as previously charged and paid in this year of assessment, 536,500 will be the correct charge for this year. Hence, 65,700, which is a mere subtraction of this, will be refunded to relieve capital allowance. And note too that this same figure is, which was 30% of 225, has now been included in the capital allowance that was relieved. it was previously part of the tax paid, but now it has been refunded to form part of the capital allowance relief. So take your time to go through this again. Go through it again. This kind of question is, I think one question came like that. Number one in tax, is it November 2005 or 4? I think 25, 24, 25, 26, November 1, November question number 1. Now look at the summary of tax paid. So 2001 tax, I didn't touch it, so it remains the way. 2002 tax, I didn't touch it, it remains that way. 2003 tax was touched. Instead of 604, we are paying 536,500. So the rest, you didn't pay tax. 1, 2, 3, 4, 5. You didn't pay in this 5. This is the ultimate year. So 4 years before the ultimate year, you have 0, 0. You've refunded 65,700 here. So that's what you get for carrying back your capital allowance. So I'm taking my time to do this because it may come out again. If it comes out again, it's likely going to be a number 1 question, or they might make it simpler for you and it may not be number 1 question. So the next thing here is the capital allowance on hire purchase. When we say hire purchase, it means that you are buying the stuff. Now you're entering into an agreement, but you are not paying everything all at once. You are paying it in bits. What will happen is that, 1, the capital allowances that you are going to be paying, you have to calculate the capital expenditure to be paid. Because when you are doing hire purchase, the money you are paying monthly or yearly or quarterly or weekly includes finance charge or hire charge. It includes hire charge. So the best thing to do is to strip out those finance charge from the capital element. When you strip them off, then you are going to be taking your capital elements as your qualifying capital expenditure. In other words, next class, I'm going to start from question number 6, and we'll explain how to do capital allowance with hire purchase. Then after that, that's the last thing, because I had to linger a lot. This question is long, not too long. The one that we just did was longer. This one was not too long. That's the end of the topic. So, but I'm going to take the first 10 or 15 minutes to do this. Then we'll enter the topic for the class next time, which is my time with you is going to be on Friday. So while you'll be looking at this and be preparing your assignment I gave you before, the next topic we'll take is loss relief. So when you get to know your basis period, you get to know for accessible profit, you get to know for capital allowance, you know your carryback, you know your hire purchase. Loss relief is another big thing that will make you pass your exams. Loss relief is our next topic. When we do that, then you are granted to do some other kinds of tasks. So let me look at questions that you may ask here. I don't hope to have questions. Okay. I observe that there is no question. And that means everybody here was understood the topic. So no problem. We all understood the topic, right? So if you have any question now, this is the time you can ask your question. If there's anything you don't understand, we have about 5 minutes to talk about it. I believe everybody can hear me. You can all hear me. Yes, I'm not on mute. You can all hear me. So if you have any question, anywhere you're not clear, if you cannot ask now, ask it in the WhatsApp group, then we'll talk about it. I believe I can be heard clearly, just as I can be seen. So if you can see me, you can hear me, that's fine. So one thing about installments, let me just show you now, since we have small time remaining, because we'll still do the same question, but let me just give you hints now. The hint goes to the workings. Now look at the workings now. I'm looking for the higher charge per installment. I'll look at my initial deposit. My initial deposit is a capital expenditure. I'm looking at my quarterly investment or quarterly installments. Look at the dates. I was told to do it between this date and this date. And they said I'm going to be making 10 installments. So it's going to be 500 times 10, which is 5 million. So total that is expected of me is 8 million. But the question says, if I were to buy the assets now, in January 128, look at how much I'm going to pay, which is the cash price. So when I less it, that means 1,100,000 is my higher purchase price. That's the finance charge. Total finance charge. Now I want to bring it to each quarter. I'll divide it by 10 quarters. That means in each payment, I am making 110,000 as my finance charge. So when I look at it, how will I get my capital payment? Each installment I make, I pay 500 naira. But that 500,000 naira is not all capital in nature. 110,000 is finance charge. So when you remove it, it means that 390 out of 500 is what is your capital charge. So what you'll be doing now, you'll be using 390 to multiply what you are doing. So if you look at what I did here, I used 390 with my 3 million, becomes 3 million, 390. If you go here, you see 390 multiplied by 4 quarters. Go here again, you see me 390 multiplied by 4 quarters. You go to the last year, it's just remaining 390. So you see 390 is what I am using instead of 500. So, but by next class on Friday, you're going to understand how this works, because that is another thing you should know about capital allowance. Then with that, we'll wrap it up and go to loss relief. I thank you all for making this class a memorable one. Like I always say, I love all of you, and one of the best ways to pass your tax is to be happy with it. Be happy with the tax, be happy with your teacher, don't have any problem, and practice, practice, practice until you become perfect. Take your past questions, look at capital allowance questions, and practice. And one thing I should tell you is capital allowance question is a time waster in exam. It's a time waster. So do as much as you can, time yourself, and stop and just leave it. Make sure you take your time to do your workings, because workings will give you more mark. So, and just stop. Don't wait until you finish your capital allowance question. It's too much. Capital allowance is a time waster in exam. And is this your stage, they will be bringing capital allowance. So practice, practice, practice will make you to be fast in computing the workings, especially when it has to do with carry back several years, and especially in higher purchase. So practice it again and see how you can reduce the time it takes you to do capital allowances question. I'll see you again on Friday. The other teacher will continue where he stopped on Thursday. So till then, have a good night. and sleep well.